a hope and a dream at the edge of the sky. And your life is a story like the wind. Your life is a story like the wind. I'm searching for the spirit of the great heart to hold and stand divine. I'm searching for the spirit of the great heart under African skies. I'm searching for the spirit of the great heart. I see the fire in your eyes.
Well, good morning, everybody, and welcome to our client webinar, a client update webinar. Thank you for your taking the time to join us this morning, and thanks to Dan and from the Excel Academy for helping on the technical side. It's my great pleasure to welcome as well to our webinar Andrew Lapping. Andrew is our Chief Investment Officer, a friend of over 20 years. And just to give you some update, I mean, Andrew and I met each other when I was at Orbis and he was at Allan Gray. 2021, I convinced him to come out of retirement and join us, and we've been working together fabulously. We think we make a great team. He is certainly the best investor I've had the pleasure of working with, and it's a privilege to work alongside him. So I'm sure I might be the face of, you might know my face a little bit more than Andrew's, but you'll certainly, I see, experience some of his professionalism today. So let me just, and then also we have Hal, one of the other directors and head of operations, and he's going to be moderating the questions. So please, when you've got some questions, put them in the Q&A. We'll endeavor to go through the presentation fairly briefly and quickly and leave lots of time for Q&A. There's lots going on right now. I'm sure you've got questions lined up. So let me share my presentation there, and then we can go through it now. So we know that there are some people who are joining us today who know us well. There are some who know us less well. And so just to briefly touch on to give you some background, we're a value investing firm, and our philosophy is that price matters. And that really holds true for whether you're buying a car, if you're going on holiday. Making your money go further makes sense. And so what we do is we look around the world for value. Okay, we are not constrained by the crowd or the benchmark. We don't care where the companies are based, within reason, and we are guided by value. That is our guiding light. And when we find those companies and they come through our investment screening process, we approach them like an astute business person would approach the business. Okay, we analyze the historic cash flow, the long-term cash flow over the last 10 years. What has the company generated in cash? What are normal margins, and what have they done with the cash? Have they paid off debt? Have they paid dividends? Have they made acquisitions? Have those acquisitions been smart and well priced? And when we do that, that helps us assess the company's normal earnings. And once you've assessed the company's normal earnings, what do you think are normal earnings, you can calculate a fair value for those normal earnings. And that gives you a potential upside. And we say, well, what happens if we're wrong? How much are we risking here? We also consider management, and we want management to be on our side, not just good management, because you can get good management who are only interested in their own pocketbook. But what do we mean by on our side? So have they done good deals? Have they been smart? Have they overpaid for acquisitions? That type of thing. Have they given themselves too many share options? So that's how we assess management. We assess management by the numbers. And we avoid over-leveraged businesses because they bring in a new amount of risk. You've got to be very careful about having too much debt, especially at a time in recent years when you've had rising interest rates. And so we prefer the business to generate their returns not just from having leverage in the system, but in having a decent return on assets. And we know we're not going to get everything right. We are dealing with the future here. We're going to make mistakes. The key is when we make a mistake, try and recognize it quickly, because every large mistake started off life as a small mistake, a small loss, okay, and try and admit them fairly quickly. And so that's what we do. Now, what do we do differently from many of our peers in the industry? Well, the first thing is we don't make macro forecasts. And the recent week, the recent few days is a great example of that. I'm sure many of you were sitting there on Sunday morning having heard the news about the bombing on Saturday night and thinking, well, the market's going to be down a lot. Oil price is going to be up a lot, and a couple of days later, that hasn't happened. The market's up and the oil price is down. And so that's a great example of, even if you can accurately predict the outcome, even if you knew America was going to bomb Iran, you didn't know how the market was going to respond. And that is the same for the Trump tariffs. It is the same for the pandemic, etc. So we don't spend our time making macro forecasts, and we seek to capitalize on other people's forecasts in that regard. We don't meet management. I've spoken a few minutes ago just about how we assess companies, and we believe we can assess the company's management and the quality of management from the numbers. When did the management team take over? What have they done? Have they gained market share? Have they lost market share? Have their capital allocation has been sensible? That's how we assess management. And we avoid highly rated businesses and narratives. And what do we mean by that? So, the market can fall in love with stories. And perhaps a recent example is the obesity. We know we're an obesity epidemic here, and there's a duopoly of companies. There's Eli Lilly and Novo Nordisk who have got the market. And so you could have paid a high price for those companies, believing the story, but you're down 50% on Novo Nordisk. So we prefer to go where the capital isn't going. And what we mean by that, it's pure economics, really, which is that if an industry is attracting a lot of interest, then what happens is capital is invested in that industry and the subsequent returns will be lower. And a great example of that recently is the EV or electric vehicle industry, where Tesla was attracting a lot of attention. All the car companies around the world invested heavily in electric vehicles, and now electric vehicle prices are falling. Okay, so we like to go where the capital isn't going. We have a small team. We have the luxury these days with technology. You don't need a big team to fly around the world, we believe, and it makes for efficient decision making. You're not trying to coordinate 15 people's diaries, so we rather have a small team. We use technology to its fullest, and that is just, that is how we do it, and it works particularly well. Another area is we ignore turnover. So use portfolio turnover. Many investors like to say, find these great businesses and hold them forever. Unfortunately, great businesses don't always stay great businesses. You look at something like Intel. Intel dominated the market many years ago. You could have correctly predicted that computers were the future. Intel's the same price as it was in 1997. Okay, so what we like to do is find a company which we think is underpriced, and when it reaches fair value, sell that and reinvest the proceeds. And so that generates turnover, but we're only interested in returns. Okay, and we have one fund, and that is our global equity fund, which allows us to move around the world efficiently, capitalizing on the opportunities wherever we find them. So clients don't have to sell a North American fund and buy an Asian fund and incur capital gains along the way. We do that within our fund structure. And we don't run any segregated mandates. And that means we can have a smaller back office team, and we want to manage money, not people. Okay, so any client who comes to us and says, well, we've got $100 million, can you please run a fund for us on the side? The answer is no. Put it in the fund alongside us and all our other clients, and that'll help reduce the total expense ratio for everybody, and it makes for an efficient back office system. So that is what we do differently. And here are our returns, and I won't dwell on this for too long, other than to say it's important to recognize we started back in late 2008, and $100 is currently $647 at the end of last month. And if you think about what has happened, coming back to those macro comments I made earlier, what has happened through the life of the fund, we had the tail end of the global financial crisis. We had the European financial crisis in 2011. We had Fukushima in 2011. We've had the pandemic. We've had the Ukraine war. We've had Hamas. And we've still managed to capitalize on each of the opportunities that those crises presented and compound wealth just by doing sensible, investing at sensible prices in decent companies. And so that is comparing ourselves to the IA Global. But it's always important. We had some investors on some platforms who redeemed upon the Trump tariffs and the market being weak, and those investors lost out on the rebound. And so whenever there's a crisis, it's always important to know that we will be looking for the opportunities in the crisis. Just to touch on our year-to-date performance, and this is up to the end of last month, so we're up 23% in dollars. And our top 10 winners only contributed 9% of that 23%. Okay, so we are not dependent on one outlying winner. And we think that that's good for clients, because if all our returns had come from NVIDIA, let's say, well, then it's a total bet on, are we going to find the next NVIDIA? So we like our returns to be widely dispersed. We don't take outsized bets. We take very conservative bets, and we don't use words like or phrases like high conviction. So we want to, this is a bet on the process. And so our top 10 winners have contributed 9%. Our top 10 losers detracted 3%, and our total, all the losers together, detracted 4%. Where of which are the regions that have generated the returns? Well, Europe has done particularly well. So for us, it's contributed 13% of the 23%. Asia has also been a winner. Hong Kong, and more recently South Korea. North America, we have a low weighting in North America, and North American markets been disappointing, but we've managed to generate some of our returns in North America, and then the remaining bit Latin America and Africa. And if you look at the top 5 winners, and we'll show this with the losers in a second, our biggest contributor of that 23% is ABN AMRO with 1.5%. And we've been in ABN AMRO for a long time. We've actually sold our full position. Similarly with Alibaba, when there was excitement over the Chinese stimulus, and then DeepSeek, etc., some of those Chinese stocks ran hard, and we capitalized on that and have taken profits in Alibaba. Foot Locker we profiled that in our fact sheet last month. It was a position that we took in the depths of despair, and it's a chain of shoe, a shoe retailer, and that was taken private. And that is not a unique case. We've had many companies taken private over the years while we've held them. It results in a nice uplift to the NAV because these companies are bid for premiums, but also it vindicates, we think, our process in that our approach to acquire these companies, and from the mindset of an astute business person, is vindicated when these companies get taken private. Again, we have sold our position in Foot Locker. We reduced our position in Bank of Ireland. Some of the European banks have done well, and we still hold the same position in KB Financial, which is a Korean bank. So top 5 winners, only 5.6% of the 23%. But importantly, when clients invest today, they're not buying yesterday's winners. They're buying the fresh portfolio that what we think are the best opportunities today. In terms of the big losers, you can see total losers year to date has been 4%. Of that, just under 2% from the top 5 losers. Sappi, we still hold. We're a little early there. We think it's meaningfully undervalued. And Sally Beauty Holdings, similarly, Sappi is a pulp and paper company. Sally Beauty is a beauty retailer in the US specializing in hair care products. And small caps have been a difficult place to be. We still think that is incredibly undervalued, and so hold that. And Haier is a Chinese white good manufacturer, and we still hold Haier as well. Viatris and Universal Health, two US healthcare companies that we have sold. So we recognize we made a mistake and we exited, but you can see the loss that we incurred is substantially lower than any of the gains that are large gains. And that's really the key point. When you recognize you made a mistake, don't lose too much money. All right. Now, one of the other things we think are useful is this notion of upside and downside capture in terms of recognizing and how do you view risk. And what we want to know is when we get it wrong, we don't lose too much money, as I said, and when we get it right, we do well. And what this formula does, and this is from Morningstar, is it says in positive months, what percentage of the market's positive return have you captured? And in our case, it's 98%, which we don't think we're going to outperform in really positive months. But what percentage of the downside has the fund captured in negative months? And only 58%. Okay, and that's what we would expect with our approach, focusing on margin of safety. If you contrast that with peers, and this is the IA Global Index, 91% of the upside is captured, but 102% of the downside, and that is the challenge. When you're capturing more of the downside and less of the upside, it's a problem. So I think I'm going to hand over there, Andrew, to you to just talk about some of our top 10 holdings in the next few slides.
Great, thanks, Sean, and thanks for the intro. Appreciate it. So just speaking about our top 10, I think there are a few important things to take away here. The one is it changes. So if you look at this top 10 today, it's very different from what it was, say, in January. The second thing is that Sean touched on something about position sizing, and that's because we are not high conviction people. I know there's some managers out there who say, oh, they have very high conviction in this stock, very high conviction in that stock, and they have 6, 7, 10% of portfolio in a single company. We're not like that. Why is that? The future is inherently uncertain. So we would rather take lots of small decisions and say we write 60% of the time than a few big decisions. It just, the odds work out better taking lots of small decisions. So you can see our biggest position at this time, TV Asahi, is only 2.8% of the portfolio, so quite a modest position. And in truth, as I say to people, in a perfect world, we would like 50 positions in the portfolio of 2% each. As it happens, it's not like that because, got things coming out, things coming out. But we like to make smaller decisions. It moderates risk, and we think it's good for clients at the end of the day. And also, Sean and I have got our savings invested in this fund. We don't want to go and put 10% in one stock. We get it wrong and you lose a very large percentage of your savings. We're not going to do that. The other takeaway, casting your eye in this top 10, is just the vast array of different types of companies. We've got TV Asahi, a Japanese terrestrial television company. Got Mattel, a US company that does toys and games. You've got Shinwan Financial, the second biggest bank in Korea. And then actually what's extremely unusual at the moment, we happen to have a large tech stock in the portfolio, Alphabet, which we've recently acquired with EasyJet, an airline. But the kind of common theme about all these is obviously we think they're undervalued. We think they'll give our investors a good total rate of return over the next 4 or 5 years. And that's how we model. We look at normal cash flow, what we think a fair multiple to place in that normal cash flow is, what dividends or buybacks we're going to receive, and therefore what return we hope to get from these investments. Moving on to the next guy. So, and this will follow through into the next couple of slides in just terms of where the value is. So you'll see in a minute, we don't have much exposure to the US. That's not because we hate the US, not because we dislike US companies. It's just we don't find undervalued companies. And it's not for lack of looking. We find that companies there, A, trade at big valuations, B, often focus, or I should say often attempt to mislead investors by speaking about what they term free cash flow. It's actually not free cash flow because unfortunately in many US companies, a vast amount of the free cash flow is bought, you're spent buying back stock to offset share option dilution. And we look at free cash flow after share option dilution. And that's why we find more value in Europe, we find more value in Asia, emerging markets, etc. So it kind of makes sense that that a lot of our portfolio is positioned where the kind of top-down valuation looks more aggressive. This doesn't drive our decisions, but it does help us know where to look. So Sean touched on the use of technology and how we try and find new investment ideas. We obviously have various ways we screen for ideas. The other thing we do is we fish where the fish are. So we look where there should be opportunities. So we discuss where's out of favor. Most recently this year, you had a situation were people worried about the political situation in Korea. So, and we knew that A, the Korean won had been weak, B, the Korean stock market had been very weak. So we had a look, and we actually found some very exciting opportunities. So we didn't focus on Korea, like where are the opportunities? That's where we look. And we know that there's probably not a deep pool of opportunities in big US tech. So we don't spend an awful lot of time looking at those sectors. Moving on to the next slide, you can now see in the little green bars where the Ranmore portfolio is allocated across the world. And just for comparison, for your information, the blue bars are the MSCI World Index. The MSCI World Index obviously heavily skewed to the US. So some people look at this and say, how can you take a risk like that? For us, it's the exact opposite of a risk. For us, we look at our own portfolio and we say, actually, we're very pleasantly diversified across the world. We've got 25% of fund odd in Asia. We've got a 15, 16% position in North America, exposure to Japan, exposure to Korea, exposure to China, exposure to other emerging markets. So that's actually how we look at it. We think we are well diversified across the world. And for us, the risk that matters is losing money for our clients, not whether the market does this and we do that. We want to generate real returns for our clients over a long period of time and avoid risk. And a question we often get is, do you have hard caps on sectors and regions, etc.? We don't have hard written down caps, but Sean and I apply our minds. We say, what are we comfortable with having exposed to Hong Kong or China? We discuss it. We think, what are the risks? What's the upside? What's the downside? And we say, okay, even though there might be incredible value there, we're going to cap it at this level. A good example is, say, European banks. We found fantastic value in European banks over the last couple of years. You could put 50% of your portfolio in European banks. Would that be wise from a risk point of view? No, because things can go wrong. You don't know the future. So Sean and I say, okay, what's the weighting we're comfortable with in European banks? 15% portfolio maximum. Okay, well, let's find the best European banks to put within that weighting within our risk comfort levels. Moving on to the next guy. This for me is interesting, and it's, again, the green bars are Ranmore versus the World Index, and you can see we've got about 40% of our portfolio in large stocks, with the remainder in somewhat smaller companies. And a couple of things at play here. The one is where we find the value. So we happen to find the value in smaller and mid-cap companies. But to an extent, that makes sense. Why? Well, firstly, a lot of people have moved towards passive portfolios, which is absolutely fine. But many of the passive indices tend to focus on the large cap companies. Many value managers and managers that focus on smaller companies have ceased to exist over the last number of years. So fewer people are looking at smaller companies. So there's less competition there. Well, where are you likely to outperform? Are you likely to outperform by finding value in a company that's got 60 analysts looking at it, poring over every detail, or are you likely to outperform looking at a small or mid-cap European company that's got 2 analysts and no one cares about? Well, we think you're more likely to find a valuation dislocation, which is what we're looking for, in an uncovered company, a company not many people know about. So that's why we look here. But just for context, when we talk about small, it's a big world out there. And for us, we probably wouldn't invest in a company that had a market capitalization of below $1 billion. And $1 billion in the global scheme of things is minute. I think a small cap in US speak is less than $15 billion or something like that. And the other thing we look at is liquidity. What does the stock trade? Does it trade plus $4 million a day or less? What does that mean? It means, can we easily invest in the stock? And if for some reason we relook at it again, new information comes to light, and we think actually this is not a company for us, can we easily exit position at a little cost impact to our clients? So you can see the logic of why we're in the smaller and mid-cap stocks. Just there's more value there, more room for your returns. touching on the top-down portfolio in terms of valuation out of interest, you can see the average stock in our portfolio trades on a little more than 8 times earnings, obviously less than the world index. For sure, the mix is somewhat different. We got more financial exposure than the world index. We don't have many material stocks, those are trade on low multiples, with one oil stock. But often you look at a like-for-like company, an industrial trading in Hong Kong, an industrial trading in the US, same ROE, maybe better cash flow generation in Hong Kong. The Hong Kong company will be trading on half the multiple of the US company. And that's why you see this, this lower valuation. The other thing that's very important to us is dividends. I know many people don't care about dividends. For us, they matter. Why? Well, over the very long term, the majority of real returns in global stock markets actually come from dividends. The second thing is, if a company is paying dividends, it usually means it actually is generating cash flow and not just saying they're generating cash flow. So dividends matter to us, and obviously valuation matters. Just for clarity, and I know some people don't understand this, is how our fee structure works. For starters, we have no performance fee at all. Okay, put that out the window. The second thing is we of the belief that if clients support us, and it's a great privilege for us that people are willing to trust us with their savings. Okay, we think that's a huge privilege. And so asset management is a economies of scale business. Our costs do not go up as our assets under management rise. So we want to share some of those economies of scale with our clients. So what does that mean? Well, it means on our first $500 million of assets under management, we charge a performance fee of 0.9%. Okay. When the assets under management exceed 500, so between 500 and $1 billion, on that 500 million, we try and charge 0.75%. And if ever one day our assets under management exceed $1 billion, on any money above $1 billion, we will drop the fee to 0.6%. As it happens, as we speak today, our assets under management are about $920 million, and our fee is about 0.82%. We also have an institutional class, which caps the total cost, the total expense ratio at 1% for all people on platforms or large clients. As it turns out, our retail fee is actually also below 1% now. So the retail and institutional fees are actually the same. And just to reiterate what Sean said earlier, we don't do segregated mandates. Everyone invests in the same portfolio. Everyone pays the same fee, no special deals. And we think that's just better for clients. Thanks, Sean.
Excellent. Thank you, Andrew. So that's great. So just in terms of to bring you up to speed in a couple of developments, as Andrew mentioned, our OCF and TER is now below 1% on a run rate basis using current assets under management. Obviously, there's some constraints, and in the fact sheet, you have to use average assets over the last year, etc. But where we are today is slightly below 1%. More recently, we're in the process of launching a GBP distribution class. It is quite a common thing in the UK market. In the UK, they like dividends. We like dividends over here, and so we're launching a distribution class for some of those clients that might be of interest. And we also have a UK bank account. So because our depository is a French bank, SocGen, some of the platforms, this inhibited some of the platforms onboarding us because they didn't have a UK bank account with a UK sort code and account number, and we've overcome that hurdle thanks to our administrators Apex, and we can now facilitate that, and we're getting onboarded on some of those platforms. We have got a new website which is in progress. It should be launched, fairly soon, we hope. And hopefully, we'll make sure that all our comments and our media and all the rest is up to speed, and it'll be a great source for clients to go and find the latest price and any of our latest comments. And as part of that, embracing a technology, we're going to be having an online application form rather than printing it out and filling it in the old ways. And so that is also going to be formed part of the website. We're working with our administrators on that to streamline the process, as well as the anti-money laundering process, which is which we know has been challenged with grey listing for South African clients, etc. And so we're hopefully going to smooth, have a more streamlined process, and in that regard as well. So really, just before we open up to some questions, and I see there are a good number of questions in the chat. We've got a disciplined process that's proven through many market cycles. We mentioned some of those events that have happened, and we've generated real returns, and we've got a portfolio that's diversified, as we both touched on, but also very different. And so for many clients, that is of benefit, because blending us with some other funds just lowers volatility, enhances returns, and we know that many clients don't like negative volatility. We're well positioned, as Andrew said, in the small and mid-sized companies, and if economic growth is tough to come by for some of the large companies, what that does is one of the ways in which the larger companies can grow is by acquiring some of the smaller companies. And so we think we're quite uniquely placed there to capitalize from some of that. We've got a declining fee structure, so we share the benefits of scale with clients. And important, please, we really want to highlight this, that every crisis yields opportunities. And if we don't know what's going to happen, is the ceasefire going to hold, is it not, etc., just know that we will be finding the opportunities there, and we'll be looking for the opportunities in a crisis. And so with that, I think what we're going to do is open to some of the questions here. Hal's going to moderate them. I see we can also see them. Hal, do you want to start off? And
yes, Sean. Okay, so a couple of questions on the market to begin with. Please can you talk a little bit about market cycles and their influence on the portfolio and your understanding of where we are now globally or locally? And then, is the market too complacent right now? There's a lot of uncertainty, and is the market pricing that in?
Andrew, do you want to run with that?
Yeah, thanks, Hal. Yes, so market cycles and valuation cycles are obviously important. A couple of important points. The one thing is we're willing to look anywhere. So there's always something going wrong somewhere, which creates opportunities. I touched on the Korea thing. China last year was a big winner for us. In actual fact, I was chatting to some clients in February when people were very relaxed and there wasn't much valuation around. I said, don't worry, something will go wrong somewhere. Just in March, we had Trump doing the tariffs, which created a fantastic set of opportunities for us. So yes, we do focus on cycles. We do look at long-term valuations, and it matters. In terms of complacency, yes. I mean, there's not an abundance of valuation out there. And in actual fact, we've got far more cash in our portfolio than we normally do. Why is that? We're about 11% cash. We normally run the portfolio about 2% cash. It's not that we think cash is better than equities. It's just that there's not a huge abundance of new ideas out there. And at the same time, a number of our big stocks are done very nicely. Sean mentioned we just sold out of ABN AMRO. That's a 2% position. Sell that in 2 days. Well, we're not going to rush just to invest the money for the sake of investing. We're going to look, find the right ideas carefully, and choose those. And just in terms of complacency, you can see it in the signs. I mean, there was just an article, I think it was in The Economist or FT the other day, of SPACs making a big comeback. I mean, SPACs are a classic sign of market excitement. So yes, there does seem to be quite a lot of hype out there at the moment, but don't worry, we're avoiding that. We're looking at our same old cash generative businesses, and I'm quite sure some crisis will happen somewhere soon, and we'll be ready to strike and take advantage of that.
Super, thanks, Andrew.
Okay, next question. How has your process changed over the past 5 years or so? And in terms of your interaction together, what happens if one of you turns bearish on a stock and the other remains bullish?
Okay, thanks, Hal. I'll take that because I can speak to the, prior to Andrew joining us in 2021. Andrew certainly helped take us up a level. Okay, so we do far more detailed work on companies and building the models from scratch, going to the source documents and building the historic income statements, balance sheets, and cash flows using the original source documents. Prior to Andrew joining us, we were using more of the Bloomberg categorized, and actually when you dig deeper, there are some discrepancies. So we are definitely making fewer mistakes than we used to make. I was responsible for all those mistakes. I'm responsible for most of them now anyway. But we're definitely making fewer mistakes, and undoubtedly Andrew's helped us take it to the next level. In terms of meeting management, not meeting management, that's no different. In terms of conference calls, I guess years ago you had to listen to conference calls, and then you could get conference call transcripts. And then we were using some software called MaxQDA to analyze those conference call transcripts. Now you can use AI as and when you want to. So, in terms of that, it's a more efficient. Technology is always improving. We're always looking at ways in which we can get more efficient. I mean, that's why we don't have segregated accounts. If you look at things like DDQs, due diligence questionnaires, we're using some AI for that. So that'll help as well. But we're always trying to be more efficient. And we go through each company. When an analyst has prepared the historic models and looked at the company, we go through line by line and grill each other and challenge each other on what our assumptions have been. And then, so that's I think what, the main things that have changed. Look, I think in terms of what happens when one turns bullish or bearish, I guess we're not talking about the market here because we don't make market calls, but I'm the portfolio manager, so I have the decision. This is not a co-portfolio manager role, which we think is really healthy. And just to explain that, if Andrew, just give you an example, if Andrew, let's say, wanted to buy Nvidia, now this wasn't never discussed, and I didn't, and so as a co-portfolio manager, you didn't end up buying Nvidia, and then Nvidia goes up however many times it's gone up, 10 times, let's say, that can introduce some challenges on an interpersonal basis because Andrew would be irritated with me, I'd be feeling bad. So the next idea he'd come up with, I'm just going to perhaps be passive and aggrieved just to try and make myself feel a little bit better. And we don't have that dynamic. So we don't want that dynamic. So I take responsibility. I have such huge respect for Andrew. If he doesn't like a stock and a stock idea, it's unlikely that I would buy it, but I am allowed to, in terms of what we agreed. So, yeah. Hopefully those answers those questions. Andrew, is there anything you wanted to add there?
All good.
Yeah.
Okay, thank you. Next question about Chinese exposure. Is there a risk that China might do something regarding Taiwan that leads to the Western world writing those stocks down to zero? Is it wise to invest where expected returns are high, but like Russian roulette, the average masks the risks of zeros?
Do you want to take that, Andrew? And then I might add something.
Yeah, I mean, for sure, the biggest risk around China is potential invasion of Taiwan, which is a huge concern for Chinese stocks as well as global stability. With all decisions, you have to weigh the upside potential and you have to weigh the risk. Okay. So it does matter the type of companies we look at. And just a few examples, a lot of them actually are just listed in Taiwan and now do business elsewhere. We were looking just the other day at a big company, the biggest producer of running shoes in the world, for Nike and Adidas and that kind of thing. And yes, they listed in Hong Kong, but actually only 5% of their production's in Hong Kong and the rest is now in Indonesia, places like that. But it falls into the Hong Kong bucket of people. The other thing we've done, we don't own any ADRs. We own all the Hong Kong stocks in Hong Kong. So at least if there's a suspension of listing of the ADRs and things like that, we're not taking that additional risk. We own them directly. Yes, for sure it's a risk. We monitor it, and it's one of the reasons that despite there's less value in China now because it's run pretty hard, but when we were finding exceptional value there, we did moderate the exposure because we were aware of the risks. We lost money in Russia, and we learned from that experience. It didn't make us. You can learn a few things from anything. You can say, oh well, I learned from the experience. I'm going to adjust my process, or I'm never going to invest in another risky place again in my life. Well, I think that would be silly because you're giving away opportunities, and you have to take a balanced approach to these things. But it is a concern for us.
Yeah, and just to add to that, because I think that's absolutely right. With our loss in Russia and our returns that we showed, incorporates a loss in Russian equities of just over 10%. Okay, but in 2022 we ended the year up when the market was down some 18%. And so it was almost 20% outperformance. I think that's right, in 2022, even though we took a loss in Russia. And so, I think, and that speaks to our process that we will then, because what happened then is many investors decided, right, that's why we're not going to buy emerging markets again. And that yielded wonderful opportunities in places like Brazil with Petrobras and in places like Kazakhstan, etc. So, so we know that there will be things that come out of the woodwork, but our process allows us to recover from those kinds of things.
Okay, thank you. How confident are you that your strategy will prevail if your AUM, say, doubles over a short period of time? And do you have a max fund size?
So, I mean, look, we are minnows in the world. We're less than $1 billion. You saw in terms of our position, our weightings in mid cap and large. We're not playing in tiny companies. And arguably, the one challenge that us value investors have is we sell too early and we buy too early. And as assets grow, it takes you a little bit longer to buy, takes you a little bit longer to sell. So you could argue that there's potential to capitalize more on the price. But really, in the grand scheme of things, we are minnows, and we think that there's lots of scope to grow. And even if you look at this year, I mean, we're having a good year, and our assets are much higher than they've ever been before. Andrew, was anything you want to add to that?
Yeah, I mean, just if you look at the hard data, and we know what the liquidity of our portfolios, we know what the liquidity of all the stocks we own is. If let's say we're 5 times the size in the past year, like let's say we managed 5 billion, it would not have changed a single position size across the portfolio, not one. So, and that's, 5 times greater than we are. And, I don't think we will ever be very large. We have no plans to be very large. That's not our goal. Our number one goal is to give real returns to clients. Our number one goal is not to be very large. So if we do start becoming bigger, we will just cut back on the marketing. In this world, you can't close because we're on platforms and things like that. So you can never actually close the fund. But the other nice thing about a fund, we niche. We're not what most people, they want to track the index. They worry about the S&P 500. We're not for them. We're not for most people. But so we a niche product, and I think we always stay like that.
Yeah. Yeah, and if you just look at those top 5 winners that I had, I mean, ABN AMRO, Alibaba, those are enormous companies. And KB Financial, even Foot Locker, it's $1 billion company, and we bought that position in 2 days. So really, we could certainly be multiples of the size.
Okay, thank you. What are the key drivers for the decision to reduce positions or sell entire positions?
Well, that's pretty easy. I mean, there's really the first is when the nice thing about being a value investor is that you have what you think a fair value price. Okay, so when the price deviates from that, you know what to do. If it's very close, then what's your expected return over the next few years is tiny. And so then you say, well, how do I have to compare that remaining expected return, which is very small, to some new ideas coming through the portfolio, which are much larger? And so then you know what to do. You sell that company and you buy the others. So that is the major determinant, but also we evaluate our positions as though we didn't own them. And so when a company reports results or some new information comes to light, we say, well, if we knew this now, would we own the company, knowing what we know now? And if the answer is yes, well, and it's cheaper, we buy more. And if the answer is no, well, then we exit. Andrew, was there anything you wanted to add to that?
One very quick point. We also trade around positions a lot.
Yeah.
So let's just say position X, we find the stock, we think it's great. Sean and I discuss it. We discuss what do we think the correct position size is given the risks. We think a 3% position size. Okay. Then let's say it appreciates and suddenly becomes 4% of portfolio. Well, 2 things have happened. One, it's a bigger weight in your portfolio, which is riskier. The second thing, because the price has moved, the expected return has fallen. So you say, well, actually at this expected return, what would our position size be? Well, our position size would only be 1.5% of portfolio. Okay, so we sell the position. Conversely, if we buy a stock, we think this is the upside, this is the downside, we buy a 2% position, goes through hard times, the stock falls, nothing else changes. Well, obviously, the expected return is now increased. We increase position size. So we do trade around positions a lot.
Yeah. And those ABN AMRO, and Alibaba would be great examples of that. We took ABN AMRO from 3.5% down to 1.5% late March. Little did we know that a few days later, Trump would make his tariff comments, we now had cash to be able to take advantage of these European banks, including ABN AMRO, which fell some 20-25%. So, and then we have now sold those. So yes, we definitely trade around positions. We think it enhances our returns. How?
Okay, thanks. Do you have a minimum upside hurdle before buying a security?
We want a double-digit return. So we want a double-digit total rate of return. That is our minimum.
So just be clear, that's an annualized return. So we'll say, what's our expected annual return over the next 4 years? Is it 11%? Oh, that's interesting. Okay. If it's 6%, it's like, no, let's put it aside, watch the price.
I see. Yeah, I see. There's one question, Hal, which I think I'd like to just deal with. You have a small team. Does this increase key man risk? And yes, it does. But I think there are a couple of important things here. The first is that it's larger than it used to be. The second is that, for obviously we'd have business continuity things. Andrew and I won't fly in the same aircraft, all that type of thing. Okay, he's based in Spain. I'm based here in the UK. And if something happened to me and I fell off my bicycle tomorrow, my wife wouldn't sell a single unit in the funds. She knows exactly what I think of Andrew and the team, and so there would definitely be none of that. And I think also, if you just take it a step further, if you say it's like Berkshire Hathaway, which has done phenomenally well, that was a small team. Warren Buffett and Charlie Munger. So, large teams, you tend to get more mediocre returns, one would suggest. I mean, there's no research which suggests the larger the team, the better the performance, probably the opposite. But even if in the disastrous situation where something were to happen to the whole team, well, it's a highly liquid UCITS regulated fund, and the fund would be liquidated and clients would get their money back. This is not illiquid private equity type investments that you're totally reliant on. Andrew, was there anything you wanted to add to that?
All good.
Okay.
On one particular stock, what do you believe is contrarian, quotation marks, about your Alphabet position?
Yeah, maybe I'll touch on that since I looked at the stock. A few things. So the one is we think so for sure people are negative about the company. They're negative about a couple of things. The first one is AI, and will search move from, let's call it Google, to things like ChatGPT and people looking for direct answers. So they're negative about that. And the second thing people are negative about is antitrust. So they've got antitrust issues in the US, they've got antitrust issues in Europe. That's the one thing. Now we look at the valuation. So the company trades about 18 times earnings. At the moment, cash flow is less than earnings. Why? Because they're investing a lot of hardware infrastructure. Okay. But we think that'll pass and depreciation will rise. So let's just say it's on a 4 or 5% free cash flow yield longer term, when the capex starts to moderate. Then you say, well, what's the growth rate? Historically, they've been growing at about 12% a year. We think that'll slow. Why? Because as their penetration and advertising gets bigger and bigger, it becomes harder and harder to grow. But then you look at the upsides. The one is they're spending a vast sums of money on things that are currently generating zero returns, whether that be the robotic taxi story, other things which they're kind of moonshot plans. That company could cut costs in a massive way, from whether it be AI doing more work for them, AI doing more work on the moderation stuff, AI doing more work on the software things. Google's margins are actually much lower than they should be. This is actually, I think, quite similar to Meta. Remember when people turned very negative on Meta, it was that 2022 when they're making no money. Suddenly they're like, okay, we can actually cut costs massively, profits went through the roof. I think Google could very easily do the similar. At the same time, you have platforms which like YouTube, great platforms, growing very fast, huge barriers to entry. So actually, if you look at the barriers to entry, free cash flow generation, and the valuation in the current markets, we like the stock. We think you can quite comfortably get a 10% total rate return over the next 4 years from the company.
And just to also emphasize, we're not contrarian for the sake of being contrarian. Okay, just quite 9 times out of 10 when stocks are down, they deserve to be down. There's real problems there. We're trying to find those unique situations where they're down for no good reason. And so we were contrarian in buying Korean companies, contrarian in buying Japanese companies and Hong Kong listed companies. But it wasn't like things were going badly there. So it's trying to find those opportunities, without, not contrarian for the sake of being contrarian. That is the key point I wanted to just highlight there.
Okay. With a weak dollar, could we not see a big move in commodity prices? If mining stocks do well, are you going to miss the party? You're underweight materials.
We've looked. I've been looking at a number of commodity stocks. The problem is a lot of the big ones are very iron ore centric, and iron ore's had a 20-year bull run, and I think that's only now starting to return to normal, and the profits are still very high. So we're not a huge fan of iron ore. Yes, the outlook for copper is good, but the problem is if you look at standalone copper companies, the copper companies, a lot of copper exposure, you get very high valuations. So, and we also look at the chemical companies, but there's a huge amount of capex going into the chemical industry in China. So there's massive supply. And as I said before, we don't like to go where the capital's going. So chemicals are a concern. There are a few niche Japanese chemical companies we own that make very niche chemicals. So we're not big in base materials, but it's not for lack of looking. Yeah.
And also just to highlight, we don't mind missing parties. Okay, we missed the EV party, we missed the AI party. It doesn't detract from our returns. We don't suffer from FOMO, and we're not really worried about missing out on parties. If you look at so I think that's an important point to highlight. Our process is not dependent on that. It's quite often when everybody sells to get exposure to those types of parties, okay, that's what creates the opportunity for us.
Okay. Currencies. Do you take into account currency hedging? If nothing, what impact does US dollar weakness have on your performance? And do you consider currencies when investing?
Yes, we do. Currency is very important, and actually the weaker US dollar for us is not necessarily a commodity story. It's like, well, there could be more opportunity for things priced in dollars. And why does it matter? So we don't look at macro, as Sean said, we look at long-term purchasing power parity. What does that mean? So often, let's just take when Liz Truss wanted to do things in the UK, I believe that was October 22. Two things happened. The one thing is the pound on a purchasing power parity basis absolutely collapsed. It went to like 103 against the dollar. And at the same time, you had domestic shares being very weak. So people become worried about the country, they hurt the currency and they hurt the stocks. So you say, well, actually, let's look at the valuations. And you can say, actually, in a very cheap currency, we can buy cheap stocks. So we invest there. As that played out, two things happened. One, the currency recovered to more normal levels, and second, the stocks recover. So when measured in, let's say, dollars, you actually won on the currencies and you won on the stocks. We've done the same thing with Bank of Colombia in Colombia, where currency was weak, banks were weak. We've done the same thing in Korea, currency weak, stocks weak. So we do look at currencies and we're cautious about overvalued currencies. So in actual fact, it would be nice now, the dollar's been so weak and interest rates are going up. Would it be nice if US stocks have been very weak? And then we could have said, oh, you can buy cheap US stocks in a cheap currency. Not that it's cheap yet, but even so. So we do look at currencies, but we don't hedge anything. So we very much believe it kind of comes out. So yes, the fund is the main price is in dollars, but you can price in whatever you want, we price in euros. None of those are hedged. It's just a direct translation of the dollar price into euros or dollar price into pounds. And when we make a Japanese investment, we just take the cash in the fund, buy Japanese yen, buy the Japanese stock. There's no hedging.
Yeah. And being underweight the US, has contributed to our performance relative to the world index this year to the extent of about 4%. But, we've also in recent years because we've been underweight the US in the last couple of years and the dollar has been strong, that's detracted from returns. So it's probably comes out in a wash. And also with global businesses, they might be listed in one place, but got operations in another, but costs in a different place. So it gets, it sounds good in theory, but hedging currencies effectively can be problematic. I see there's lots of questions on the cash. And so really just to reiterate, we had at the end of last month, you had Skechers getting bid for, you had Foot Locker getting bid for, and so those stocks and taken profits, we don't just apply that cash then across the portfolio, because there'll be some stocks with lower returns. Why would we want to be allocating some capital to the low returns? So as Andrew mentioned, our top 10 does change, and that will depend on the timing of cash flows, the timing of the stocks. And so if we're adding to stocks that we think we've got higher rates of returns, that's what we're trying to do. We're trying to optimize the total rate of return of the portfolio. So you should not see that cash as a call on the market. We have got lots of ideas that are in the research process at the moment, and we'd be surprised if the cash is as high as this level in months to come. But yeah.
Yeah, if you looked at, Sean, correct me if I obviously haven't been here the whole 15 years, but over the 15-year history of the fund, the average cash probably would have been what, 2.5%?
Yeah, it's low. You want to have a little bit of cash because, to quote Warren Buffett, you be greedy when others are fearful. Well, you need some cash to be able to be greedy with, but you don't want too much. And so, a small single-digit level of cash would be the long-term average, I'd guess. And so but it shouldn't be seen as a market call. We've got stocks in the research process, and we'll be allocating as and when we think the time's right.
Okay, liquidity. Do you hold any illiquid positions?
Well, we've got some that are less liquid than others, and so but they're not going to be big. And if you look at our risk numbers in terms of, I think we could get rid of 85% of the portfolio in a day, using 10% of volume, something of that order. So there will be some smaller positions which are illiquid, but they'll be tiny and insignificant.
But just be clear, those positions will be we will probably own maximum of 1% of the company's outstanding share, if that. 2, it's all normal listed stocks on big markets. We don't play in funny little markets. And C, when Sean says a liquid, he's talking exit position in 10 days, or maybe less. Yeah.
Okay. You may have already addressed this. You've mentioned valuations and free cash flow several times. How important is EPS growth in the process? And is that reflected in the track record in that more of the return has come from dividends and revaluation as opposed to EPS growth?
Earnings drive share prices. Okay, so we want growing companies. People think that there's a misconception that value investors only want boring, old, historical, horrible companies. That's not true. We want growing companies, and so we do want companies to grow earnings, because if you deconstruct where you're going to get your return from, you get your return from dividends, from earnings growth, and from re-rating. And if you don't have earnings growth, it's very hard to get a re-rating. So we do look at growing companies. We just don't want to pay too much for them. So earnings growth is definitely a factor.
And on that point, revenue growth is extremely important. We will almost never buy a company that's shrinking revenue. So often, if you think of value managers, people think, oh, you buy junk. No. And why? Let's just take a company that's the revenue is shrinking and it's got half the market capitalization in cash. Okay. I promise you, the management's not going to say, oh, we're just going to shrink this business forever and pay out all the cash. The management say, oh, we must stop this shrink, we must make acquisitions, we must do something, and suddenly capital allocation falls apart. So we're very cautious about companies that are shrinking revenue.
And especially at the moment where you've got inflationary costs, we look at these companies regularly. SG&A, so your sales, general, and admin, if those costs are going up with inflation and your revenue is shrinking, it doesn't take long for your profits to just get evaporated away.
Okay, thanks. We've got 2 minutes left. So
yeah.
When do you decide that an investment is a mistake?
When do we decide when an investment is a mistake? Well, when we look at it and we go, knowing what we know now, when new information comes to pass, that could be a result, it could be the result of other information that's not financial results. It could be, you've done a bit more work in the industry. You started off on one company and now you thought that was really good, but now you think there's actually another company in the same industry that's better. But if we own a company and revenue starts shrinking, earnings starts falling, operating income starts declining, which we weren't expecting, that is when we'll recognize that it's a mistake. Yeah.
Okay, thanks. And the last,
and to be clear, we've had stocks where we've sold a position and rebought it again at a lower price or even at the same price later. So yeah.
I see we get this. There's this question here, Howell. Can you give us a sense of what your hit rate was? Well, I mean, what percentage of stocks do we? Obviously, this is on absolute returns. So far this year, just over 70% of our positions have contributed positively, and just under 30% have detracted value. And that's a little higher than the last couple of years. I mentioned that we're making fewer mistakes. And so, and what has our turnover been? Well, turnover, we don't really worry about turnover. It's a number. One should expect higher turnover for value managers because we value sensitive. And so, as the stock approaches fair value, we're going to sell, and selling generates turnover. So you could have low turnover if you've got a whole lot of stocks that never get anywhere near your portfolio, your target price. And so we actually think high turnover is a good thing, because it's good for clients, because new clients are getting a fresh portfolio, and it also means your process is working because you're taking profits when the prices get close to fair value. So, but we would think that when our theses are playing out, that our turnover will be high, and we would not be surprised to have turnover over 100%. And especially if, as Andrew mentions, we trade around positions, that also generates turnover. But the important thing is these days the broking costs are really, really low. And in some markets you'll have stamp duty. In the UK and Ireland and places like that, you have stamp duty, which does add transaction costs. But we focused on returns, and so we're not worried about that kind of thing. Right. I think I hope that's been of benefit. Please feel free to send us any feedback. Thank you for your time again. Thanks to Andrew and Howell and Dan, and to Joe and Bianca for putting this together. And we appreciate your time and hope that's been insightful.
Yeah, and again, it's just as from my side, we appreciate your trust, and we strive to continue to do a good job over the next very long number of years. And apologies, we didn't get to all the questions, but please do not hesitate to email us or give us a shout at Client Services, and we will answer any questions we haven't answered. Thanks again.
Right, super. Thanks, Dan.